Of course, I do want to bring in my next guest. Joining me from Cleveland, Ohio, Greg Halter. He's the Director of Research at Carnegie Investment Counsel. Greg, it's great to have you on the show, and we do see stocks trending a little bit higher in extended trading. How does this set us up for the Fed decision this afternoon?
I guess in the grand scheme of things, we at Carnegie are long-term investors. What happens on a day-to-day basis is a lot of noise when you look back in history. So yes, certainly what is said today at 2 o'clock and then at 2:30 with Jerome Powell will be important regarding the future and how the current administration is being viewed through their eyes. But a lot of this, if you look back in history over time, really is a lot of noise.
Interesting. So a lot of noise we have seen certainly since COVID, and changes in interest rates and volatility in the 24 to 48 hours after the actual Fed decision. But I think in terms of what traders and probably investors want to glean is, what is the economic outlook? How could the Fed's summary of economic projections paint that picture for us?
Sure. I think there's really two things that will be of focus today. Number one is the employment situation. We've obviously heard a lot about what's going on in Washington, but so far it hasn't seemed to come through in the weekly claims or continuing claims. So the employment situation is one area. And the other, of course, is inflation and what's going on there. You know, we've heard recently that one area that received a lot of media attention were the egg prices, which I've seen, at least on a wholesale basis, are down 30 to 40%. So that should translate through into the consumer, what the consumer pays at some point. That's obviously just one small part, but you know, the media took that and ran with that as one area of heightened inflation. On the other side, you've got things like housing and rents, and rents tend to move slowly, and they've been coming down. So that will actually be a positive plank, we think, in terms of the inflation numbers.
Yeah, of course, the Fed does manage the federal funds rate, but a lot of investors and traders will follow what's happening in the bond market to get a sense of rates as well. We've seen the 10-year Treasury yield come down a little bit. What does that mean for the Fed decision, the fact that the 10-year has moved down on its own?
Well, they really, again, as you say, they don't have control over the longer term rates. The administration is jawboning to get those rates down. You look at least historically, a 30-year mortgage would trade at 100 or be priced at 100 to 150 basis points over the 10-year. We're nowhere near that now. We're probably 200 or 220. You know, if we could get mortgage rates down to 6%, 5.5%, 5%, that would certainly help the housing market, which would be a huge plank because of the multiplier effect across many other industries. So I think that's what the attempt here is, to get that 10-year down, and then you get other rates following, which would be a nice boost. We obviously still have the housing affordability issue with the cost of a home, but at least on the rate side, that would help, because I think mortgage cost, or the cost of a monthly mortgage, has doubled since 2020.
What does this mean for the stock market? Can it absorb the volatility and change that we've seen?
It's a great question. I always laugh at that question because, you know, there's no such thing as no volatility. Stock prices go up and stock prices go down. We're certainly in a period of maybe somewhat higher volatility. You look at the VIX index and things like that, but yeah, it's never fun when you're an investor and you own stocks and they gyrate all over. But I think the market will be able to absorb this. You know, depending on what is said today, there could be some reaction, but you know, a day or two or three from now, the market's going to kind of forget about that and get back to focusing on fundamentals.
You know, there's been a lot of questioning as to whether or not a recession is possible. The Atlanta Fed indicator several weeks ago had indicated that the first quarter was looking at a contraction in growth, so negative GDP growth. What is the data telling you?
I think that number got revised upward because there was a huge influx of gold shipments into the U.S. So now we're back at a positive number. You know, you start looking at that, and with those kind of that variability, it makes you question whether or not it's a useful indicator. So sometimes you have to take these things with a grain of salt and pull away at the edges to see what's going on underneath.
Several rate cuts now priced into the market this year. Do you agree with that, Greg? Do you think that that's the right course of action given what we know today?
I do think so. Certainly not today, but 3, maybe even 4 this year, given what's going on relative to wages and employment. And obviously that leads into consumer confidence.
And we had a relief rally that lasted from Friday to Monday. Stocks did take a leg lower by about 1% yesterday for the S&P 500, fractional gains today. Again, what would be your advice to people who are wondering what to do with their money in this market?
Well, if you are a long-term investor and have a horizon of 3, 5, 10, 20 years, if you've just gotten into the workforce, our suggestion would be to max out your 401k if you can. There's nothing wrong with an S&P index fund to have exposure into the market. I saw a book by Martin Housel. Every page was the same. It was the S&P 500 chart from 1917 or something. It was kind of comical, but it basically tells you a story that, the time in the market is certainly more important than timing the market.
Yes. Yes, that is the famous quote that we know. As you mentioned there, Greg, time in the market is more important than timing the market, and I think the data would show that as well. But of course, we cover all the twists and turns here for our viewers on NYSE TV Live. That's Greg Halter, Director of Research at Carnegie Investment Counsel. Greg, thank you.
Thank you.